Most investors chase shiny assets like cryptocurrency for quick gains. That path leads to traps, as Warren Buffett warns. He calls it non-productive, zero output, just speculation on the next buyer. You likely buy in on hype, hoping prices double. This ignores what builds lasting wealth, assets that generate cash. Understand Buffett's reasoning and you'll spot traps while favoring productive investments like businesses. You'll protect capital for compounding. If you're serious about long-term growth, subscribe now. Let's examine Buffett's exact warning. Why cryptocurrency is the trap. Buffett warns against. Buffett labels cryptocurrency a trap because it produces nothing. Farms yield crops. Businesses earn profits. Crypto sits idle, offering no income or utility. Its price depends on finding a greater fool, someone paying more later. Without that, value drops to zero. You expose yourself to this when chasing volatility. Hype drives surges, but crashes wipe out late entrants. Permanent capital loss follows. Productive assets weather storms through earnings. Crypto lacks that anchor. Consider the non-productive nature. Hold gold, and it stores value but generates none. Crypto mirrors this but lacks even historical stability. No dividends, no rents, pure gambling on sentiment. Over time, this erodes wealth. Speculation risk amplifies the danger. Prices swing wildly on tweets or news. One day, moonshots promise riches. Next, fear triggers 50% drops. You buy high on FOMO, sell low in panic. This cycle destroys compounding. Capital needed for real investments vanishes. Historical parallels confirm the pattern. Tulips boomed in hype, then crashed. No intrinsic worth sustained them. Gold holds some role in crises, yet Buffett prefers productive alternatives. Crypto fits neither. Speculative bubbles repeat. Long-term holders face dilution as new coins flood supply. Your portfolio suffers direct exposure. Allocate to crypto, and volatility drags. Returns. Track total performance net of fees. Crypto trails productive assets over decades. S&P 500 compounds at 10% annually through business growth. Crypto resets to zero in bear markets. The thing is, this trap diverts focus. Time spent watching charts steals from analyzing cash flows. You need discipline to avoid it. What this means is reallocating to what works. Now, let's break it down further. Buffett stresses intrinsic value. Does the asset create? If not, pass. Crypto fails here. Exchanges profit from trades, but holders bear the risk. Fees compound losses. Think about daily impact. You check prices obsessively. Stress builds. Productive holdings let you ignore noise. Focus shifts to life. Data reinforces this. Long-term charts show crypto underperforms. Volatility eats gains. One bull run masks years of stagnation. Buffett's track record proves the opposite. Berkshire grows steadily. Avoid the trap by questioning utility. Will it produce cash in 10 years? If no, it's speculation. This mindset protects you. Chasing crypto erodes the capital base. Every loss delays recovery. Math works against you. Drop 50%, need 100% gain to break even. Repeat cycles compound damage. Buffett's warning centers here. Non-productive assets lure with promises. Reality demands output. Shift now to build sustainably. Buffett's alternative. Invest in productive assets. Avoid the trap by shifting to productive assets. Buffett favors businesses that generate cash flow. These include quality stocks or companies with real operations. Farms produce crops year after year. Apartment buildings collect rents. Businesses reinvest earnings to grow. You build wealth through this output. Productive assets create value independently of buyers. Companies use profits to expand, pay dividends, or buy back shares. This compounds over time. Speculation relies on others. Production stands alone. The core principle is buying cash-generating machines. Seek moats. Barriers like brand strength or cost advantages, these protect profits from competitors. Coca-Cola endures because no one switches easily. What this means is steady returns without constant hype. Implementation follows simple steps. 1. Analyze return on equity. Divide net income by shareholder equity. Aim for consistent 15% or higher over 5 years. This shows efficient capital use. 2. Check debt levels. Look at debt-to-equity ratio under 0.5. Low leverage avoids bankruptcy risk in downturns. Buffett avoids over-leveraged firms. 3. Hold long-term. Ignore short-term noise. Own for decades as businesses compound. Sell only if fundamentals change. Apply this to your portfolio. Move allocation from speculatives to index funds tracking broad markets. Or pick undervalued firms with strong moats. Start with 70% in productive assets. Reduce crypto exposure gradually. Compounding turns this into fortunes. A 10% annual return on 100,000 grows to over 1 million in 35 years. Patient ownership multiplies average gains. You sleep well knowing earnings anchor value. Common pitfall is timing markets. Don't chase dips or peaks. Focus on business quality over price swings. Buy when you understand the operation. Hold through volatility. The thing is, this requires discipline. Review holdings quarterly against these metrics. If an asset produces no cash, cut it. Build reserves in productive names. Now, let's look at daily practice. Screen stocks using free tools. Filter for high ROE, low debt. Read annual reports for moat clues. Paper trade first to test. Over time, this shifts your mindset. You value output over excitement. Portfolios stabilize as cash flows smooth returns. Berkshire Hathaway exemplifies this. Steady growth from owned businesses. What I mean by that is reallocating builds resilience. Downturns become buying chances for quality. No panic selling needed. This approach scales wealth predictably. Conclusion: skip crypto traps and build with productive assets that generate cash flow. Review your holdings against ROE, debt, and moats today. Comment your biggest investment mistake below. Subscribe for more frameworks.